If you're interested in planning for your retirement, you've probably taken in a lot of information from many different sources about things like finances, investing, saving. You may be what many people call a DIYer, and that's okay. But in your learning, you may not have truly taken a deep dive into what a financial advisor is and how one can help you in your journey. So in today's episode, we're going to unpack what a financial advisor is and how one can help you maximize your money, minimize your taxes, and get you to focus less on balance sheets and more on beach towels. I'm Brad Lineberger, certified financial planner.
And I'm Matt Callahan, certified financial planner, and welcome to Navigating Retirement.
So Vanguard, the king of the DIY investing institution, they did this study a while back that said, if you work with a financial advisor, there's a good chance that the right advisor can bring an extra 3% per year of value to your overall portfolio and your returns. And that's a lot of money.
It really is, especially compounded over time.
Absolutely. And I just thought it was ironic because Vanguard is built for the DIY investor. And here they are saying, an advisor can bring value.
I appreciate it. I mean, they recognize where the advisor can provide that value. And we're going to break it down, like you said, of where the areas are, because there are some things that advisors aren't necessarily helping provide some of that return.
And there's certainly things that the right advisor can help the DIYer to really benefit. So, but before we explain what a financial advisor should be doing, if you're in the market for one, or you've just been thinking about maybe it's time to explore this or think about working with an advisor, what are the things that people should be looking at if they're considering working with one?
Yeah, a couple things come right to mind that I'm sure all of you are Googling or looking up on ChatGPT is what is a CFP and what is a fiduciary and should I be working with one?
Certified financial planner,
Yeah.
and yes, you should. To me, that's table stakes.
And fiduciary, I would say yes as well, because there's two standard of cares in our industry. There's the suitability standard of care and then the fiduciary standard of care. And suitability standard of care is just, if I met you today, Brad, and said, asked you a bunch of questions and said, here's your investment that you should have. I just need to have that be suitable.
Yeah, in my world, that's code for salesperson.
Right. So
salesperson, they're going to sell you something.
Commissions
Run
are involved.
away.
Yes. And then fiduciary, I have to be giving advice that is suitable at any given moment.
Oh, imagine that. You have to do what's right for your client. Shocker. Unbelievable that there's these two standards, but that's how it is, and people need to know this as consumers.
So definitely looking at that, but I look at your name and you look like you have what's called alphabet soup after your name.
I got a few I know. I am a self-admitted, I'm a geek, and I know I probably have a few too many. Lifelong learning, I think I think that's a character trait that people should look for when working with an advisor is not necessarily all the designations, but they got to have a CFP, they got to be a fiduciary, and they have to be committed to education, empowerment, coaching. They really need to be a financial coach.
Yeah, I love it. So I have alphabet soup as well, and the way I look at it is that you should be working with a certified financial planner no matter what. And I don't want to say that people that don't have that designation aren't good advisors, but if I'm working with someone, 100% I want someone to have gone through the rigorous coursework to make sure that they have that. But the other designations, they matter. I like the lifelong learning, like you said, but some of them have specific areas that they work with clients. So they take deeper dives in the material.
Okay, so now that we've identified what are the things that people should look for in an advisor, now let's break down what are the things that an advisor should be doing to actually earn that fee and bring the value that Vanguard says is is over 3% per year.
Yeah. So I guess the first one that comes to mind is, can you help provide value in building a portfolio?
Yes, and that's interesting you bring that up first. Unfortunately, I think there are financial advisors that's all they do. And in my opinion, if you have an advisor and that's all they do is the investment stuff and they don't do anything else beyond, ditch that advisor. Find a new one or do it, because the investment code has been cracked. So whether it's Betterment or Vanguard or Schwab or Wright Capital, 25 basis points, for 25 to 30 basis points, you can get a great low-cost investment portfolio. So a good advisor should be doing so much more than just asset allocation and low-cost investments. And so in my mind, the place I start with is having a really good strategy for spending money in retirement. So taking money out of the portfolio, I think adds value.
I agree 100%. I mean, if you've got your taxable investment account, your IRA, your Roth, maybe some cash on the sidelines too, like how do you know where to pull the dollars from? I mean,
Right.
just the tax implications from each of those accounts can cause a detriment to your overall plan.
I'll give you an example. In fact, we have a case study and we just shot a video on it. A client of ours was creating about $100,000 of income and paying zero in taxes. And we broke down some of their choices. They've got Social Security income, dividends, and then they needed to make up the rest of their spending from somewhere. And so having a strategy in place as to the most tax efficient place to get it, most people would just say, all right, I'll just go ahead and take the rest out of my IRA. Well, not only did that result in federal income taxes, it resulted in more of Social Security income being taxed. And so by having great strategies and having the right software, everything else, we were able to figure out, take some of it from the IRA, but some of it at long-term capital gains. They ended up paying zero taxes, nothing. For Fed and state.
Huge, because people aren't thinking of that. They don't necessarily know the tax code, and nothing wrong with that if you're a part of that group. That's not what you've trained to do or not what you're looking for, but
Yeah.
there are ways to save significant dollars through.
And the other one, speaking of taxes, is asset location. So everybody's heard of asset allocation. Don't put all your eggs in one basket. Asset location is put the right investment vehicles in the proper investment accounts to create the most tax efficiency. What does that mean?
So let's say that you have an IRA or a qualified account and then a taxable investment account. You may want to put your growth investments in your taxable investment account and then your value or your dividend paying stocks in your qualified plan. The reason being is because that qualified account is going to shelter the
Right.
income or dividends being produced by with bonds you could put in there as well.
Right.
And then in the taxable investment account, typically those growth stocks are reinvesting in the companies and not spitting out dividends, so it's more tax efficient. So over time, that can add to your bottom line.
And Vanguard puts that savings at somewhere between 30 and 40 basis points every year.
And it sounds like a simple concept, which a lot of these are, but it's just that most people, some advisors, most do-it-yourselfers aren't doing these little things on a regular basis.
No, and this stuff adds up. Wait till you go. We got a bunch of power-packed
Yeah.
stuff that's going to be really helpful today. How about tax planning? I don't see any DIYer doing proper tax planning, and I'm not. And most CPAs, look, we got a few that are good, but unfortunately, many of them, what they're doing is they're collecting data. They're looking at what happened last year, and then they're reporting. It's a scoreboard of, hey, this is what you owe. And I equate that to driving your car down the road while looking in the rear view mirror. Could you imagine that?
Oh yeah, so hard. And I hear it a lot of times, even with some of our clients, is that, hey, Matt, hey, Brad, my CPA is great. They file the taxes. They tell me how much I need to pay. They let me know my quarterly payments, but they don't let me know
No.
other strategies of what to do. And
Right.
I jump for joy at that point, because it's like, lean on me, lean on us for doing that.
And we'll coordinate with
Yeah.
your CPA.
Because we're looking at not just this year, we're looking 10, 20 years down the road of what can
Yeah.
we do today
Yeah.
to save you on taxes. Hopefully this year, but more importantly, not running into any of those tax
Well, you
consequences.
said it. It's running multi-year tax projections, and even the most sophisticated DIYer I've met, you would have to be just a professor at Excel to do this. I just don't see how you're going to do it in Excel. I mean, the software that's available today to financial planners is so powerful, and I really think the magic happens when the financial planner is coordinating with the CPA, with the estate planner, so that coordination with the client's best interest right in the middle.
100%, because then the clients can see you're all working as a team, and even if you're the one coming to the tax professional with the ideas, if you can get their stamp of approval and
Yeah.
get them to make sense, it's better off for the client.
Yeah. So another thing that Vanguard said financial advisors do that creates value, and again, most DIYers, if not all DIYers I see, are just not doing this, tax loss harvesting. And we all know we should buy low and sell high, and maybe that's why people don't do it. But tax loss harvesting is a sophisticated strategy where when markets give you lemons, you make lemonade by selling things when they're down, but immediately replacing those securities, those investments, with similar securities, so you still remain fully invested and you participate when the market recovers.
I mean, 2025 has been a perfect example of using tax loss harvesting. So, for example, I mean, most of you are familiar with the S&P 500, and that was down or very volatile early this year.
Down almost 20%.
Right. So
in
we
April.
were able to take advantage of those losses and replace the S&P with similar investments that are like S&P. And we've seen portfolios, almost all portfolios that are up year to date,
Right.
and have realized losses that they're able to reduce their adjusted gross income.
That's right.
By $3,000 a year.
Every year until those losses are used
Right.
up.
And then the also to use those losses to offset gains.
And you can rebalance in the future tax-free.
Mhm.
And it's not just 2025, it's 2022, 2020, 2018. I mean, it's every year is going to give you an opportunity to tax loss harvest. Nobody does it.
And one thing I ran into yesterday, this was interesting because the client was saying how they're loving that the returns are great, but it's making them more scared seeing the account value get so big. And one of the things I could bring up is like, hey, if there are negative years, and where I'm going with this is he has a large inherited IRA. I was like, it actually could be good if the markets go down, so then we can do a distribution from that inherited IRA and move it into their taxable account. So pay
Right.
less taxes on that distribution, but then have those assets grow in the taxable account.
And that makes me think of two other strategies, tax gain harvesting
Mhm.
and then also rebalancing.
Mhm.
Those are two things that most DIYers don't do, and good advisors are doing that, which is bringing value. So the first, tax gain harvesting, is identifying if you're ever in tax brackets where you pay 0% in long-term capital gains, so the 12%, the 10 and 12% bracket, you actually sell some of your winners while you're up
Mhm.
and pay nothing in taxes, considered tax gain harvesting.
Yeah, and to piggyback on that, if you want to do tax gain harvesting or Roth conversions, maybe you do a combination of the two, but it just
Right.
opens up those gates to to allow you to do those if you did the tax loss harvesting to begin with.
That's right.
And then, I mean, you say rebalancing, and everyone has heard this word.
Yeah.
And I don't know how many times I hear the do-it-yourselfers. They say, "Oh yeah, rebalancing," but their portfolios are concentrated typically
Yeah.
in the shiny object or the
Oh,
one that's doing great.
the
And they're
winner
like,
of the day. S&P
I
500,
don't wanna
Mag
sell.
7.
I don't want to sell because this one's doing so good. Well,
Uh-huh.
you understand the concept of rebalancing, but you're not actually executing on it.
Well, it's like, you want to lose weight, right? And you go to the gym the first few weeks of January. But look, we all need a trainer. We need a nutritionist. We need a trainer. We need people in our lives to hold us accountable.
What are you trying to say?
I'm not saying anything. You look great, man.
Thank you.
Married and a kid, you look fabulous. Just keep fighting the fight.
Yeah, but yeah, exactly. Coach for the gym, coach for your financial planning. I mean,
Yeah.
it just helps to give you that extra
Yeah.
headway. I mean, even professional athletes are paying for coaches or
You
have
got it.
coaches.
For golfers, every
Mhm.
golfer has a coach.
Mhm.
Yeah, and so why that's so important is if without that discipline, you start to get overly concentrated in things that look. The tide always turns. We saw it. It wasn't that long ago after the .com bubble. We had the lost decade where the S&P lost 1% per year for 10 years. Right, so it's the rebalancing that's controlling risk, that's going to prevent you from having to go back to work in retirement and be the Walmart greeter, as we say.
But I was actually surprised. We think this is such a simple concept, but Vanguard says that just regular rebalancing adds 0.35% return out
Right.
of that 3%. I mean, that's one of the higher ones if you're just regularly rebalancing the
So
portfolio.
we've already, between asset location, tax loss harvesting, and rebalancing, we've already come up with enough cost savings to where you can go work with a good financial advisor, and they're doing these things, and they're earning. You're basically working working with them for
Mhm.
free at this point.
How do you have any advice for the people out there that they understand that we just said that you can get an advisor for free for 1% just by doing these things, but if they can't necessarily see the dollar amount that you're saving, how do they get over that hump?
Yeah, that's right. It's not like, okay, we do these things and then all of a sudden here's 0.3 extra on your it does take time. It shows up on the statement over time as you start to track your balances and you start to realize, wow, we're doing pretty darn good here. And honestly, I think that's the biggest problem that people have, is because it's not like you're getting a ticket that gets punched that says, here is the results of what we just did. Although the Roth conversions, those are meaningful. So that's where I think that is an example where you can actually see value immediately. And good financial advisors are doing things like Roth conversions, backdoor Roth conversions, mega backdoor Roth conversions. Those are all strategies we talk about all the time. And most DIYers and quite frankly, a lot of bad advisors are not doing these things.
Exactly. Okay, I love that. And then so spending drawdowns, we talked about just which accounts and which one's the best to go. What's your advice there? Where to start? Is it more of a case by case kind of thing?
To me, it comes down to the tax situation. So I look at where are they going to be the first few years of retirement and looking at a combination perhaps of taxable monies so they can do the Roth conversions. But that's where having the multi-year tax planning projections comes into play. So everybody does need to have a strategy, and it is unique. No one's taking the time to do this. The other one I think is twofold. I think it's helping people to avoid the big mistake. Honestly, in my opinion, of all the things we've mentioned, to me, this is the biggest one and the one that's the most underappreciated by people because people think, I don't make big mistakes. I don't need behavior coaching. I'm perfect. Okay. You're telling me in your 30 or 40-year investment career, you've never sold once out of fear or you've never chased anything out of greed?
Or even considered it. I mean, you're psychologically, your mind, you never know what event is going to trigger you to make a poor decision over that time frame. I mean, every time a black swan event happens, I mean, COVID, the financial crisis, all these things, it was basically the first time that this happened, and we don't know what's going to happen in the future. It is going to be new, it's going to be scary, and it may cause you to make those poor mistakes.
Absolutely. And it's funny because every time I've asked somebody, okay, did you flinch and sell? And they're like, nope, I didn't. I don't need this. Then you look at their portfolio and they may not have sold in the moment, but they're so overly concentrated in a few securities, as you mentioned earlier. It's very rare that I see people who didn't panic and sell at some point on the journey or get overly concentrated and just not necessarily get lazy, but just lack of rebalancing. I just don't see people doing this well. I see such opportunity for improvement that it's worth its weight in gold if you're with the right advisor.
Yeah, and I'm not necessarily on board with Bitcoin or cryptocurrencies yet, but to piggyback on that, I saw that if you bought crypto in 2009 or 10, like $1,000 worth, it's worth $2 billion today, and it's just no one has or would be able to hold it long enough with all those ups and downs and the craziness that happened along the way to get there.
Right. And so I think a couple of other things, and another underappreciated aspect of working with a good advisor is the fact that when you got someone on your team, you can actually delegate these things to and not have to worry about this stuff and not have to, you could get more sleep at night. You don't have to do this anymore, and you can actually go have a life.
Yeah, I like to tell people, hire the professional worrier for you. So that's the advisor. Let them worry for you, but if you have a good one, they're not necessarily worried either. They've got the globally diversified portfolio. They trust and have faith in the future, so things over time will get you that extra 3%. And
I see people that they like doing this stuff, and that's fine, but usually the spouse doesn't like doing this stuff, whoever it is. And so the continuity that can get created.
That's a great point. And we typically see one spouse over the other is the financial person. But have you thought about if the one that knows what they're doing is no longer with you, do they have somewhere to go just to have their finances in order to, break it down even to paying the bills or the credit cards or things like that? We've run into different scenarios like that.
And that kind of leads into really the last bit here, which is the 4 C's. The 4 C's that a good financial advisor should do. And you were just touching on one of the C's, which is continuity. So whether it's the non-financial dominant spouse having continuity after the financial leader dies, maybe it's continuity for the kids, so the kids know where to go. It could be the smooth settling of an estate, but that continuity piece is really valuable and often overlooked.
It creates so much peace of mind for people just from what we've seen. But I think they also enjoy the coaching that you get. A good financial advisor is going to, hey, here's different options to accomplish the goals and the values that you shared with us. Here's pros and cons for each of them, and really help you think it through to make that right decision.
They're going to educate you and they're going to empower you. So you feel like, oh, okay, got it. I have a really good strategy at play, and I have good people executing this strategy, so I can go live my life, and a good advisor is doing things that the average person is just not thinking about doing.
Yeah, the other day, I mean, we had a client that they wanted to pay off their mortgage, and their interest rate is 2.75%. They had the significant dollars that just came into their household. So could they pay off their mortgage? Absolutely.
Yeah.
And so they told me it would really help them sleep at night. This would give us just all the peace, not owing, yada yada. And I said, okay, that's great. Let me just give you the other side of the coin. Financially speaking, if you can go get 4% in a money market,
Right.
you're making more dollars to park it in a money market account and then still continue to pay interest. But what we found out, a couple things. It was really their goal to just have that paid off, and we listened there like, hey, the answer is yes, do that. But also we looked at the tax return, the mortgage interest wasn't helping them out.
Right.
So even though financially to make your dollar work harder for you, what was more important to them was to pay it off, and that you could just see the relief in their bodies of, yes, we get to pay this off. We heard both sides and the pros and cons, and they made the decision.
In other words, you coach them to have peace of mind. You help coach them on the strategy that gave them peace of mind over maximizing return on their dollars. And at the end of the day, they were very grateful.
Their plan works, their goals are being accomplished, and their values were listened to. So win-win-win for everybody.
Yeah. And I think of the 4 C's, the other one that goes without saying is competence. And that goes back to work with the certified financial planner, work with people that know what they're doing, work with people that are modern financial advisors that keep up on the tax code and the tax planning strategies. And these are all great questions that people should be asking advisors of, hey, what are your favorite financial planning strategies? What's your philosophy on tax efficient withdrawals? What's your philosophy on asset location?
You bring up a good point, because the advisor you work with, they could be the best at working with a specific person.
Right.
You need to find the person that works best with you.
Right.
Yeah, you're a team for, 30, 40 years if
Right.
that's the case.
For example, you're just about to transition into retirement. You want to be working with specialists who help with retirement income planning in that transition. But if you're a professional athlete, or if you're an executive with compensation strategies, RSUs, you want to be working with people that really know you and know your challenges. And those are all fair questions that people should be asking the advisors. They shouldn't be shy. Ask those questions, because truly the right advisor is going to earn their fee 3 or 4 times over time, for sure. But so don't be shy in asking those questions.
And then going on to the next C of convenience,
Yeah.
asking the questions. Don't work with someone, or if you choose to, whatever, but don't work with someone where you have to call a 1-800 number
Yes.
to get your question answered. And then that person doesn't know the question, so you get bounced around.
The phone tree.
Yeah. So
Oh, Lord.
I would look for someone that you can, meet virtually or
A
come into the office.
human
Yeah.
answers the phone when you call.
Yes.
A familiar face is on the other line, knows you, knows your
Yeah,
situation.
it drives me crazy. I'm the one that pushes 000 until I can just get a hold of someone,
Totally. Totally. But no, to your point, and convenience can take the form of maybe you prefer to meet in person, and so you want to find a firm that's close to your house. Great. Maybe you prefer Zoom because you don't want to deal with the traffic. Great. Good firms are set up to meet people where they're at and provide that convenience so that optimal outcomes are being achieved, all at a reasonable price.
Right.
So we've given the audience a lot to think about, a lot to chew on. I would suggest, I would encourage people to work with an advisor, but hold those standards high. All the things that we outlined today, you should expect, you should demand that your financial advisory team is able to bring that sort of value, because that's what you're paying for.
And if you want to explore what it's like working with us, you've seen some of our work on the videos, but give us a call, set up a time to reach out, and we're more than happy to help.
As Matt mentioned, if you're interested in learning more about Seaside Wealth or what it's like to work with us, check us out on the website, seasidewealth.com. You can start the process there, and we'd love to hear from you.
Thanks for listening. If you're watching us on YouTube, be sure to give us a like and subscribe.
And for the audio version, check out navigatingretirement.net, and also take a look at our past episodes.